Good morning. Good. Welcome to the session. It's week 6. We're continuing with the accounting equation double entry system, and which you have to know for the assessment that's coming up. Let's have a look at some of the learning outcomes for this lesson. We must be able to analyze transactions under the accounting equation, define assets, non-current assets, and current assets. We must be able to define liabilities, non-current liabilities, and current liabilities. Explain what is meant by a proprietary account, find income and expenses. We discuss the profit motive and determine how gross profit, net profit are derived. Explain and apply the rules of double entry. So those are the learning outcomes for this session. Okay, let us recap on the rules of the double entry accounting. Remember, for every debit, there must be a credit, and vice versa. For every credit, there must be a debit. Okay, so let's have a look. Our assets, when we debit them, they increase. So if we, in my T account, if I debit it here, it means it increases. So if this is my bank, struggling to write with the mouse, but I'm trying my best. This is my bank. So money comes into my bank on the left-hand side. That's what we mean by debit. That increases, and money goes out on the right-hand side. That's the credit. So the bank is an asset. The money comes into my bank on the debit side, and that means my bank balance increases. If it goes out on the credit side, it decreases. Okay. Let's look at the next one. If we look at income, and income, it works the other way. If we debit it, it decreases, and if we credit it, it increases. So let us assume there's my sales account. Is an income. Okay, so if I have a sale, I'm going to credit my sale, which means my sales increase. Okay, and what happens then? Remember, 2 transactions, 2 entries. There's a credit on the sales increase. And if it's cash, it's going to go to my bank. And I'm going to have money coming into the bank there. Okay, capital, that is the money or proprietary account, the money that comes in from the owners of the business. It works the same as the sales. If we credit it, it increases. And if we debit it, it decreases. Okay. So liabilities, that's people that you owe money to, things that you must pay. So let's assume I've got a creditor account here. So a creditor will have a credit balance. That means it increases. If you've got a debit balance, it decreases. So let's assume I'm going to be paying money from my bank, and I'm going to pay my creditor. There's the bank. It goes out from the bank. It goes into the creditor account, gets debited to that side, and that will reduce the liability. So that decreases the account on the left, and it increases the account on the right. Okay, expenses works the other way around. If I debit my expense, it increases. For example, I pay wages from my bank. I'm going to pay wages. It get credit my bank, and I'm going to debit this account here. And that will increase the amount of wages. Okay. If I credit this account, it will reduce it. Drawings, that is the goods or money that the owners take out of the business. So if we debit that, it increases, and if we credit it, it decreases. Okay, so that's the most important rules of the double entry system. Okay, so we've already said if we debit an account, it's on the left-hand side. If we credit, it's on the right-hand side. Okay, let's have a look at the definitions. An asset is a resource controlled by an entity from a past event, which will lead to income inflow of economic benefits, or increase of economic benefits. A liability, on the other hand, is an obligation for the company to settle from a past event. They obtained a loan or something, which will lead to an outflow of economic benefits. Income, it's money coming into your business, increase economic benefits, and expenses decreases economic benefits. Capital, that's the owner that gives money or assets to the business. The owner can give cash, or for example, you can say, okay, I've got a bakkie we're going to use in the business, so I'm transferring the bakkie from my personal name into the business's name, and that will be brought in as capital into the business. Drawings, that is money or goods or assets that the owner takes out of the business. So the owner can take cash, he can take some stock inventory if he wants to. They can take any asset. If they want a desk that they're not using in the office anymore, then he takes it. Then it's also be part of drawings if there's still asset value to it. Okay, now the accounting equation. We say assets is equal to owner's equity plus liabilities. Now this equation must always balance. Okay, so if assets increase, then it must increase on the right-hand side. If assets decrease, it must decrease on the right-hand side. Okay, so if we manipulate this equation, we can then say owner's equity is equal to assets minus liabilities. Or we can say liabilities is equal to assets minus owner's equity. But as long as you know the equation, assets is equal to owner's equity plus liabilities, then you can always do the algebra, the maths, and just calculate the other variable. Okay, so let's have a look at this one. A company has total assets of 263,000 and total liabilities of 125,000. Calculate the value of owner's equity. Okay, so we have seen owner's equity is equal to assets minus liabilities. So there we go. Owner's equity is the 263,000 minus the liabilities of 125,000. And that will give us owner's equity of 138,000. Okay. Let's have a look at the next one. A company has total assets is 572,000. There's owner's equity of 375,000 and current liabilities of 26,500. Calculate the total value of non-current liabilities. Okay, we know that assets is equal to owner's equity plus liabilities. Liabilities we divide into current and non-current liabilities. So they've asked us now to calculate the value of the non-current liabilities. Okay. The assets is equal to owner's equity plus liabilities. Therefore, liabilities is equal to assets minus owner's equity. Okay. So we know that assets is 572,000. That's the 572. Owner's equity of 375. Okay, which means the liabilities must be equal to 197,000. Okay, so the liabilities made of non-current liabilities plus current liabilities. Therefore, my non-current liabilities is equal to the total liabilities minus my current liabilities. So we know the liabilities must be equal to 197. There we go, 197. Minus my current liabilities of 26,500. And that leaves me with the balance then of 170,500. That is my non-current liabilities. To number 3, a company has owner's equity of 295,000, total liabilities of 78,900, and non-current assets of 33,800. Calculate the total value of current assets. So let's start with our equation again. Assets is equal to owner's equity plus liabilities. Okay, so there we've got our owner's equity of 295. We have liabilities of 78,900. So we know that our assets must be worth 373,900. So our total assets is equal to non-current assets plus current assets. Therefore, current assets is equal to total assets minus current assets. So there's a typo there. It should be non-current assets on this side. Okay. So we're going to take our 373,900, which is from here, 373,900, minus our 33,800. That comes from there. And that will leave us with current assets of 340,100. Okay, so if we're going to look at analyzing transactions, okay, we first have to think of what accounts are affected, what rule do we use, what effect is applicable, and what are the debits and credits. Okay, so we'll have a look at the examples in the textbook. Okay, let's have a look at the inventory. This is something that you need to know how to account for inventory when you do transactions, which accounts are debited and credited. Now, we use two different methods of recording inventory. The one is called the perpetual inventory, and the other is called your periodic inventory. Okay, so what we mean by perpetual inventory, this is normally used in systems where you know the price of every product that you purchase. So when you sell the product, you know what the exact price is of that product. Okay, so that will be a perpetual inventory system. Then we have what is called periodic inventory system. This is now used where you don't know the exact price of inventory that you've purchased. Okay, if you think about it, if you go to Pick n Pay and they have these loose tomatoes on the shelf. Okay, now they go to the market every day and they get their fresh produce from the market. So today, a box of tomatoes would be 30 Rand, tomorrow is 34 Rand, the day after is 28 Rand. So they will never know with that particular tomato that is putting in a plastic bag for you, what the price was of that particular tomato. So for that, we use our periodic inventory system. So, and that's just the difference between. So the periodic works from a period, what was my total purchases for the period, and how much do I have left? And then you can work out what your, this is how we calculate our cost of sales. On the other hand, the perpetual, you know what the value is and you're going to use that. Okay, so when inventory is purchased, under the perpetual inventory system, we're going to debit, we're going to book all that stock that we've purchased into our inventory account or stock, the asset account. Okay. With a periodic inventory system, we will debit the expense account, okay, the purchases account. So this goes to our income statement, and this one is on our balance sheet. So we perpetual inventory, we book it to an asset account, so that's our balance sheet. For the periodic inventory, we debit an expense account. Now, when we sell the inventory, we're going to do two, under the perpetual inventory system, we're going to do two entries. Okay, first we're going to record the sales, okay, for the revenue. And then on the other hand, we are going to record the cost of sales. Okay, so if we have stock that we're selling for 100 Rand, we're first going to credit sales for 100 Rand and debit our bank for 100 Rand. But that stock that we sold for 100 Rand, let's say it costs 60 Rand. So I must remove 60 Rand stock from my inventory accounts, and I'm going to put it as an expense, which we call cost of sales. Okay. With the periodic inventory system, it is simply we're going to debit our bank and we're going to credit sales. That's all we do. There's no inventory involved here. Okay. The third event, additional cost incurred to get the inventory on the shelves. For example, import tariffs, carriage means transport cost. Okay. So what we will do under the perpetual system, we're going to debit the trading inventory account. So we book all those costs to inventory. And under the periodic inventory system, we're going to debit the applicable expense accounts. Okay. So trading inventory under the perpetual inventory system is updated as transactions take place. And the year-end balance should be the same as the value of the stock on the shelves. You will physically do a stock take the end of the year. And you're going to say, okay, I've got 10 million worth of stock on my shelves, and that must balance to your asset account for the inventory of 10 million. With the periodic inventory, you don't make any adjustments to that. It stays as it is. Cost of sales, that is recorded at the point of sales. That is when I talked about when inventory gets sold, that is the where you record the cost of sales. The cost of sales is reported when we sell it, and under the periodic inventory, we don't use cost of sales, we simply use purchases. Okay, let's have a look. We were in the class, we would have done this, and we would have given you time to do every transaction. But okay, what I will do is I'll explain the transaction to you, and we want to record those transactions in a table that looks like this. You must put your dates. You must say what happened to assets, owner's equity, and liabilities, and which account we debit and which account we credit. Okay, so if you can just write down the format in which the answer must be. You will be getting a question like this in the assessment that's coming up. So you must make sure that you understand how this works. Okay, I'll give you a minute or two just to draw the table. Don't copy the answers yet, just draw the table so that you have the layouts. Okay, let's then go to the transactions. Okay, Mr. Craze recently opened a small marketing consulting business, which started trading on 1 May 2014. Below the transactions that took place during May 2014. Okay, so on the 1st of May, Mr. Craze transferred 150,000 from his personal savings account into an account in the business's name. Okay, so if you look at the transaction, what happened? We analyze it. Mr. Craze, that's the owner, transferred 150,000 from his personal savings account into the account in the business's name. So first of all, there's money coming into the business. So we know we're going to debit our assets. And where did it come from? It came from the owner. So we know we're going to credit the owner's equity side. Okay. Now we must now say, okay, which account we're going to debit and which account we're going to credit. So in this event, we're going to debit the bank account and we're going to credit owner's equity account. Okay, so when you write the answer, make sure that you will say the assets increases, so plus 150,000. And remember, the equation must always balance. So 150 must be equal to 150. Okay, so we're going to debit assets. That's going to increase assets, and owner's equity is going to increase. We're going to debit the bank account, and we're going to credit the capital account. You can check whether your answer was right. A bit too quick. Okay, let's have a look at the second one. On the 3rd of May, we purchased a laptop computer from PC Planet to assist with presentation and consulting tasks. The laptop was priced at 15,000 and was purchased on credit. Okay, so what happened? Let's analyze the transaction. We bought a computer, so we acquired an asset. So we know we're going to increase our assets. Have we paid for it? No, we haven't paid for it. So we're going to owe the money. So if we owe money, it's a liability. Okay. So our liabilities will also increase. So our assets will increase and our liabilities will increase. So which accounts we will do? We're going to have computer equipment or equipment will be debited and creditors will be credited. Okay, so that is how this transaction will work. We're going to debit the computer equipment, and if you debit an asset, it increases, so it's going to be plus 15,000 on the asset side, plus 15,000 on the liability side, and we're going to debit equipment, and we're going to credit creditors. There's our plus 15,000 on the assets, plus 15,000 on the liabilities. Account debit is equipment. Account credited is creditors or accounts payable. Okay, let's look at the 4th of May. Mr. Craze decided to take a loan from Easy Bank to help fund his business. 80,000 was deposited into Market's bank account and is repayable in 5 years' time. The loan incurs interest rate of 15% per annum. Okay, we're just busy with the May. Okay, so what is the transaction? The company borrowed money from the bank, from Easy Bank. And that 80,000 was deposited into the account of the company. 80,000 came in. So we're going to increase our assets by 80,000. And where did it come from? It came from Easy Bank. So it means you still have to pay it back in 5 years' time. So it will be a liability. So liabilities was also increased by 80,000. Okay, so we're going to debit our bank and we're going to credit loans because you've got the loan from Easy Bank. So we will credit loans. 80,000. Just write that down and we'll go and check and see if you got the answer right. Okay, so there we go. Our assets goes plus 80,000. Our liabilities goes plus 80,000 again. You must always check that the equation balances. So equal sign. So plus 80,000 is equal to plus 80,000. And then we're going to debit our bank accounts because the money came into our bank. And we're going to credit our loan accounts. Okay, let's have a look at the next transaction. Mr. Craze paid wages of 500 Rand to a casual worker who helped hand out advertising pamphlets at a traffic light. What is the transaction? We took money from our bank account, which means we are reducing our assets. Okay, where did it go to? We paid an expense. Expenses fall under owner's equity, but as you spend money, it reduces the owner's equity. Okay, so we're going to minus our assets for the bank, and we're going to minus owner's equity for the expense. So we're going to credit the bank because money flows out of the bank, and we're going to debit the expenses. I'm going to write it down. I will check it. So let's have a look. And there we see we are minusing our assets by 500 because money went out of the bank account. And we're going to reduce 500 Rand in owner's equity. Again, you see the 500 minus 500 is equal to minus 500. Yes. So we debit our wages, our expense account, wages, and we're going to credit our bank account. Let's have a look at the next transaction. Mr. Craze provided consulting services to a client for which he provided the client with an invoice for 1,800 Rand. Client agreed to pay Mr. Craze the amount owing on 12 June 2014. Okay, let's analyze the transaction. We provided a service. Okay, so that will be income. And the issued the client with an invoice of 1,800, and the client agreed to pay the next month. In other words, this is money still to be paid to the company. So the client is the accounts receivable or the debtor. So we're going to increase our assets, the debtors, by 1,800. And we're going to credit the fee income or sales. Fee income for service organizations, we talk about fee income. So we're going to credit the owner's equity. That's where income and expenses go, under owner's equity. So we will debit our accounts receivable with 1,800, and we're going to credit sales with 1,800 in the 15. Okay. Let's look there. There's our, we increase our accounts receivable or assets 1,800 and our sales with 1,800. Okay. As you make sales, economic benefit flows in, and that falls under owner's equity, so that increases there. So we're going to debit our debtors or accounts receivable, and we're going to credit our service or fee income. Then on the 17th, Mr. Craze developed a marketing plan for a client who paid 6,000 cash for the services received. Okay, so let's look at the transaction. Mr. Craze had a revenue, provided a service, and he got paid 6,000 Rand cash. So that 6,000 Rand is going to come into my bank. So we will debit my bank, which increases my assets. And where did it come from? It came from fee income. So we're going to credit the sales of fee income under owner's equity, and owner's equity will then also increase by the 6,000. If we go to that account, there's a 6,000 increases my assets, which comes from my bank. It goes into the account debited will be bank, and the owner's equity goes increased by 6,000, and we're going to credit service or fee income. Okay, then let's have a look. Now, on the 19th, Mr. Craze used the business debit card to buy his daughter a birthday gift for 450. As he left his own bank card in the office. Okay, so what is the transaction? 450 Rand went out of the business. Where did it go to? The owner took it. Okay. So we know that if money goes out of the business, we're going to credit our, goes out of the bank, we're going to credit our bank. It's going to reduce our bank balance. So assets will come down. And where did it go to? The owner took it. So the owner's equity must come down as well. So assets will go minus 450. Owner's equity will go minus 450. So the accounts, if money goes out of my bank, I credit my bank. So the account to be credited will be bank. And where did it go to? It went to the, it's a drawing, a withdrawal from the owner. So that becomes drawings. And so yeah, that is the transaction. The assets minus 450, owner's equity minus 450. We debit drawings and we credit our bank. Okay. There's the 450 minus, 450 minus, we debit drawings, and we credit the bank. Okay, on the 28th of May, paid 5,000 Rand to PC Planet in part payment of the amount owing. We owe them 15,000, so we're going to pay 5,000. Let's analyze what happens here. If I paid money, money goes out of my bank. My bank balance reduces, which means my assets reduce. Okay, where did it go to? To PC Planet, which is a creditor or accounts payable. But if I pay it to them, it reduces that balance. Okay, so my assets will be minus 5,000 and liabilities will be minus 5,000. If money goes out of my bank, we credit my bank. The account to be credited will be bank, and the account to be debited will be accounts payable or creditors. So there's the minus 5,000. And the assets reduce it by 5,000. My liabilities reduced by 5,000. I'm going to debit the creditors or accounts payable account, and I'm going to credit my bank account. Then we paid the full month's interest due on the loan. So let's have a look at the loan. Okay. I took 18,000. Was my loan amount. If we want to calculate what is my interest payable, if I borrow 80,000 at 15%, so for a whole year, it will be 18,000 times 15%. That will give you 12,000 for the year, and it's only for 1 month. So we're going to pay 12,000 divided by 12. We're going to pay 1,000. So what is the transaction? We paid the 1,000 rand from my account. So my bank account goes down by the amount. And where did it go to? It went to interest. Now, interest is an expense. Don't make the mistake of adding it to the interest does not get added to the loan account. There's some technicalities there, but for the purpose of this exercise, we expense. When we say we expense the interest, it means we immediately write it as an expense. Okay. So we know we're going to credit our bank by 1,000 rand. The assets will go down by 1,000 rand, and our owner's equity will also go down by 1,000 rand because that's an expense sitting there. So we're going to debit our interest on loan or interest expense, and we're going to credit our bank. Okay, so if you just want to check and see if you have got all the answers written down. Okay, then just the recap on our accounting cycle. Transaction took place, we have source documents, the journals, and we put them into our general ledger. What we've been doing on the previous page is very similar to our journals, because when we say this account gets debited and this one credited, and the amount, that is basically what will be in a journal. Okay. All familiar with this accounting cycle? Okay, so you can have a look at the following exercises in your textbook. 3F, 3G, 3H, and 3I. And then we'll on Thursday, we will be looking at these exercises and make sure that you have done them correctly, or we will do them as we go through the session. Okay, thank you and goodbye.